Good evening, everyone, and welcome. My name is Chetan Kumar and Bias Agent at Oswald Bias Agency, and I will be your host and moderator for our webinar, Australian Commercial Property Market Navigating the When, Why, Where, and How. For everyone's information, we are recording this webinar for educational purposes. On behalf of our panelists, we are thrilled to have you here this evening. Whether you are joining us from your office, home, or somewhere in between, we appreciate you taking time to be with us. Before we dive into today's content, let me quickly go over the agenda, and we have lined up four fantastic speakers who are experts in their fields, and they will be sharing valuable insights with you. So first speaker is Ashish Malhotra, founder and bias agent at Oswald Bias Agency. Ashish's journey from arriving in Australia with just 4K to founding a successful bias agency is nothing short of inspirational. He has built a $5.5 million property portfolio in just 7.5 years and helped over 200 clients grow their wealth through property, and is eager to share his insights today. Next, we have Nathan Haas, founder and managing director at Eagle Vision Financials. Nathan specializes in mortgage and funding with a strong background in business management. He is dedicated to helping clients build investment property portfolio that lead to long-term financial success. And our third panelist is Matthew, Senior Associate at Nicholas James Lawyers. With over 12 years of experience in residential and commercial property transactions, Matt offers sharp legal insights that are commercially focused and tailored to your business objectives. His expertise ranges from off-plan purchases to complex trust transfers. Our fourth and final panelist is Carmel, accountant at MNC Accountants. With 25 years of experience in public practice, Carmel founded MNC Accountants to help individuals and businesses manage their tax affairs and build wealth. She is passionate about seeing others succeed and loves traveling the world. We encourage you to engage with our speakers today through the Q&A feature at the bottom. And feel free to submit your questions at any time during the presentations, and we will address them during the Q&A session at the end. So let's get started. Please join me in welcoming our first speaker, Ashish Malhotra. The floor is yours.
Thank you so much, Chetan. Welcome, everyone. I'll share my screen and I'll start from there. Welcome, everyone. So, over a period of last almost 9.5 years since I've been investing, I've learned a lot thanks to a lot of educational courses, blogs, talking to a lot of people, going to forums, reading magazines, and whatnot. I've spent a lot on the education, and that's what leads me in the position today to help you understand and explain when should we be targeting a commercial and why when we look at commercial property. I see that as opposed to residential, the knowledge is very minimal, and that's why again you need a really good team, and we've got an awesome four presenters that cover across the property buying journey. So, just quickly starting with when should I add a commercial property to my portfolio? So, I'm timing myself as well so I don't go overboard. Again, idea is a lot of times I get asked why commercial and what should I be looking at when buying a commercial property and when should I even consider a commercial property. So I've over period of last so many consultations in last 2 years that we've been buying commercial property for clients, I've just narrowed down few circumstances and scenarios which may help you assess and see where you are in the journey. For example, you own a couple of residential properties and you feel it's time to diversify to a different asset class, of course, within property. Um, and this is where commercial would come into picture. Now, ideally, residential property, after all costs, work out to be 3.5 to 4% net rental yields, while commercial can give you anywhere between 5.5 going up to 8% rental yields. going to complexity, regionals or not regional location, stability of the tenant, all of that governs how the property works. But this is just a pure one reason why you can look into a different asset class and actually improve your cash flow with that. Um, the second is focusing on income. So basically, what happens is because there's higher deposits needed as well, and the rental yields, or we talk generally net rental yields in commercial, and that's where if your focus has gone to high income producing assets rather than high growth assets, again, it's an ideal time to look into a commercial property. The third and ideal scenario is you're running a small business and you need a premises, and sometimes people will buy within their self-managed super fund, or otherwise they can buy a premises for themselves and actually rent it to their business. And that's again an ideal scenario when you can look at a commercial owner occupier asset as well. Lastly, you're a very busy professional and or a high net worth investor, and why would these type of assets suit such a client or someone in that scenario is it's less hassle. There's tenant pays the outgoings, tenant is responsible for the fit outs and working on the maintenance of the property. There's less hassle, and there's longer leases as well. Of course, comes with longer vacancies, but there's longer leases as well. Now, ideally, the second part is why do I even consider? And I've covered a little bit already. Like the first instance, you're looking to diversify because you'd be looking at a balance of growth and cash flow in these high interest rate environments. I'm calling it high. People who've been investing since 2008, 9, 10, the interest rates around that time were almost 12 to 13%. I'm not that old in Australia to remember that. I know how the rates have been trending. Now, today, people call it a high interest rate environment, but with the rentals that we receive from residential properties, most residential properties are anywhere between 1,100 to $2,000 negative or even more, depending upon what you've bought. And buying a premium residential definitely would come at a bigger holding cost. Now, in those circumstances, if you're buying a commercial property, that works really in a balanced way and you balance your cash flow as well, because most commercial properties work out to be neutral or maybe slightly negative. Second, a lot of times there's buying that happens. People can accumulate deposits, but they can't compromise on the lifestyle. And again, these type of properties work really, really well in terms of managing a lifestyle. Lastly, reducing the risks. Reducing the risks, and because when you're balancing with the cash flow, and if you have multiple such assets, they can balance themselves out and you are hardly paying anything negative out of your pocket. So that cash flow supports you with a better cash flow. Um, there are a few more scenarios where I've seen commercial properties really stack up well, which is one, you're nearing retirement, which means your focus is more going towards commercial or actually cash flow, right? So consider in this way, if you've got $1 million in cash, a residential property is giving you about 4-ish%, 40,000, versus a commercial property can give you anywhere between 6 to 6.5% net, which means you're returning $60,000 to $65,000 in return. So if you're sitting on heaps of cash, cash flow is more important, not the growth, and that's what supports you. And where income is a short-term focus, again, let's say I've built a portfolio, I've got ample growth. I now would have to focus on income. So my next 5 to 7 years would be focused on building an income and cash flow producing assets. Um, Again, there are different asset classes. You can look at warehouses, retail, you can look at offices, even NDIS comes under commercial, but outside of my expertise, so I'll keep it out when we're talking. But there are ample people who can work through NDIS, or even then there are block of units which just comes under commercial also. So the second factor is loss of partner, income, or divorce. Now, this is where I see a lot of scenarios and circumstances, and many referrals come from financial planners as well. Now, this is where you've not just lost a partner, but you've lost an income as well. Divorce would mean you sell everything and you're restarting from scratch. So again, Ideally the income works best in these cases. You're sitting on heaps of cash, and again, if you have to restart at the age of 30, 35, 40, 45, you you're best starting with an income in place, and that's where commercial property definitely helps and support. Running a small business, as I've covered already, you usually renting at 5 or 6% net yields, so you're much better off buying your own property than anything else. And lastly, just less hassles, and tenants takes all the pains. So you, as a busy professional, I reckon commercial stacks up really well, especially when you are accumulating multiple properties and there's no upper limits, right? So you can buy $2.5–3 million property and still have that 6 to 8% net rentals. um, so lastly, the how. Again, there's definitely, as I've said, less knowledge, and that's why consulting the right professionals is really important. Having the right mortgage broker in place, because it's a specialized asset class, and you need people who can give you the right lending. Consulting the accountants for structures, that's why we've got Kamal, and I'll let her speak on that. So trust, bucket companies, SMS, I've heard many terms, but again, I'm not an expert on that. And lastly, just working with a good solicitor as well, because um, the due diligence in terms of legals and soliciting and conveyancing works way has way more importance than anything else. Even the lease documents needs to be reviewed. And again, there are different loan structures, accounting structures under which you should be buying the properties, which you should be talking to your accountants. um, Going back, so a lot of times I get asked questions like, how does the growth uh, how is the growth different in these properties? And now, ideally, I don't see a difference between how the properties have been growing. If I take an example, in last 10 years, property in Sydney has almost doubled in value. I'm talking residential, but when I talk commercial, and let's say offices in Bella Vista or Norwest, they've actually tripled in value from 2014 to today. Um, there are areas in Gold Coast, Arundel, for example. We bought a commercial precinct, and I'll walk you through that, which is right next to residential area. So if the residential area has doubled in value, there's no reason why commercial would stay at the same price. However, considering a general hypothesis, I've considered your residential property grows at 6% and commercial grows at 4%. Now, just at the same pace, what we can do is I've taken a 10 and a 20-year scenario. As you can see, the residential property definitely stacks up well with respect to growth, but does that growth really helps? Second is the net rentals, where I've taken an estimate of 5% in residential and 6% in growth in commercial. Now, ideally, there's something called a cap rate, which means what sort of yields you're buying the property on. But then this comparison also takes into account that I've taken the net rent instead. So if the residential property is giving you 5% and there are holding costs, the net becomes 3.5 to 4%. And this is where, in the same time frame, as you can see, what's more important is income. So without having to sell that asset, even though your asset would be valued about 1.1 million versus your residential around 1.6 million, over a period of 20 years, your cash flow is much, much better as compared to residential. So again, ideally, when people ask, would these properties grow? I think that's a wrong question. I'd say you're buying these assets for income. So, and that's why it's very important to understand when you should be looking at these type of properties. Um, and lastly, just there's a fair bit of due diligence. I think some of the due diligence we started with residential, but then I realized over a period of time, the purchases are exactly opposite to residential. You need a more peaceful location in residential, but in commercial, you need the busiest location possible. We've just bought a shop for a client at 5.5% net rental yields, but the location is really premium. It's on the verge of a very busy highway, just on the junction. It's in the front, there's an ample, there's an office spaces, there's an Aporto, there's a burger joint right next to it, there's a medical precinct. So this would improve the footfall as well, right? So which is very important. So street presence, zoning, what sort of zoning your property is allowed. So again, very important, because if you put a wrong tenant, and I've heard so many horror stories as well. A client bought a property through someone else, and the property manager did not look at the zoning before putting the tenant in. And when there was a complaint made to the council, and the tenant had to leave, and my client was sued about $70,000, which they had to pay to the tenant because of the damages. So again, that's why that zoning and all of this is really important. Now we're still building this checklist. I think we build about a good 65 points across the purchase that we are doing, and this checklist keeps getting evolved. Um, just from a residential perspective, between location and property, I believe we've made that 556 points, and this is already sitting at about 65 points. Again, coming to your tenancy reviews and looking at how to value these properties, and now looking not just a per square meter rate in terms of the space, also looking at the per square meter in terms of rental, and lastly looking at the average cap rate in that area as well. Now, one area, just you cross a road, and the second area could be entirely different. For example, Castle Hill Trading Zone, which I'm in Sydney, so I'll take that example. Castle Hill Trading Zone sells for 6,500 a square meter, but offices sell at 10 to 11,000 a square meter. Because of the location, we've just bought an office and we've paid um, 12,700 a square meter. Again, it's because of the location. It faces two streets. It's a higher placed office space as well, and a bigger balcony. So again, everything adds to the cost. Looking at CPI reviews, the tenant's business, how stable the business is. There's a fair bit of due diligence that goes into the checks. And again, I'm personally going to these sites and talking to neighbors as well, because that's equally important to understand how the building has been, how their experience has been, looking at the footfall, parking. It just list goes and on and on and on. So and most of these properties, the other thing is, are pretty much off markets. So not every property you'd see on market, because it's the listing on real estate apparently is costly as well. um, Look, that's fairly it. I'd suggest, if you have questions, keep noting down the questions and do ask at the end. Chetan would, I still keep asking your questions in the chat. Chetan would be consolidating all the questions, and we'd love to, or endeavor to, answer most. I'm taking some examples. So this is the example I've taken in Arundel in Queensland. Now this property came at 5.8% net, but the lease was 2 year in place, since 2 year, or almost 1.5 years. There was still in the first option 1.5 years left, and there were no increases done. And the beauty of this property or lease was, it was 5% or CPI, whichever is the highest. And first year it was 5%, and second year, last year, the CPI was touching almost 7%. I think last year. And this is the beauty, that immediately after buying this property, there was a 5% increase and then a 7% increase, and now the property is sitting at 6.3% net. It's 1.5 year old warehouse occupied by Coca-Cola. And that's the beauty of being. And Coca-Cola spent, I think, about $50,000 in the fit out. So this is a strata complex, and strata and all outgoings are paid by the tenant as well. So that's the beauty of owning a commercial property. And again, having a strata is not an issue, because the tenant is paying all the costs. This is a very busy precinct as well. And Arundel, you're buying residential properties on 350 square meter land for $900,000. Sorry, there's a lot of numbers. I just So this is another property. People ask, Ashish, what's the minimum? It has to be a costly property. So we bought this property in town, 2 hours from Brisbane. The town has a lot of commercial activity. It's a corner shop. It's raised by at least 1 meter from the street. And because it was in a flood zone, and this question was raised, so we had to go to town planner to get it sorted. Pizza Hut is the tenant. The lease was just 1 year old. There was 4 years in the first option, plus 5 years. The tenant was doing amazing. I went there at 10:30. By 11 o'clock, out of 22 parking spaces, 16 parking spaces were full. And I got to understand from the other tenants that at times people would have to park somewhere outside. On the left hand side, there was a super cheap auto. On the front, there was an Aldi, there was a council building and a Service Australia building. And it was a busy junction again. And in just while I was there for about 2.5 hours, I could see literally 50 to 80 trucks just passing through that area. There's a McDonald's, KFC, and all of those precincts on the same road. So this is a very busy road. This shop was just $370,000, buying at 6.2% net. You don't get such deals usually. But again, there's one example where you can buy cheaper properties as well. This was a shop of 5, and every shop rents within 3 months. So there's less vacancies too, because that's another myth. What sort of vacancies you see? This is in Perth. They bought it for a client, and this one was a 7% net rental yield. There's an option to, if you actually, you can use the walls to advertise as well in future, but that goes through different complex options. But then again, the tenant was a builder come architect who's been there in the premises for last 7 years, and he wanted to rent back, and there was a good money spent. There's about 9 to 11 rooms, and on my social media platforms, I've advertised, or I've actually given a walkthrough of this office space as well. Some of the purchases, rental increases were less, but then again, you're already getting 7%, so there's nothing wrong about this. Is also Great Eastern Highway in Perth, which you have most of the recruitment offices there. So again, and St. John's Ambulance office as well. So that's a little bit that I had to explain. Some examples that we've got, the price point, myths debunked, and lastly, just work through when should you be looking at commercial at all, because there's higher deposits needed as well. Um, I think I'm done with my time. I'll hand it over to Nathan from here. I'll just stop the screen share. But again, thank you for listening patiently.
Thank you, Ashish. Thank you very much. How's everyone tonight? Are we well? Hope you're enjoying the webinar so far. My name's Nathan, Director of Eagle Vision Financial, and I've been a mortgage broker now for about 7 years. We do residential and commercial property is what we focus on. Tonight, what we're going to talk about is commercial lending. And 4 main things we're going to talk about is the most important thing you need to do before you apply for your next loan. Secondly, what to consider when applying for commercial loans. And then I'm going to zero in to SMSF loans and give you an example of how to implement one, and also lease stock loans and give you an example of one. So what do you think? The most important thing to do before you apply for your next loan? What do you think it is? Have a plan. When we think of having a plan, what's the first thing we think about? We think about goals, we think about all these milestones and markers. But what if I shared with you about a borrowing plan? Not many of us have heard of a borrowing plan and what that actually means. 80% of my clients have more than one property. So their vision, what they want to do is build a property portfolio. And what I asked them is how many investments could they purchase in 10 years? And what do they need to borrow over that 10 years to reach that target? Does any of you know that answer? Often we just go out there and say, oh, I can borrow enough to purchase my first investment, so I'm just going to do it. Whereas there's no forward planning, there's no 10-year plan in order to get those 5 properties, because you could max yourself out in your first property, then you have to wait another 5 or 6 years before you can purchase your next property. As individuals, we can only carry a certain amount of debt at a time, so we need to plan our borrowings accordingly. And what Eagle Vision does is we zero in the fact that we help you plan out your borrowings over the next 10 years so you can achieve the goals that you want to achieve. And we call it the Property Eagle. And we go through a process where we help you define your goals. We ask you how many investment properties do you want in the next 10, 12 years. We look at your borrowing capacity. We look at your sort of risk appetite as well to see how passionate you are and see how much of a level of risk that you want to take. And then we go together and start crafting your plan. And we've developed specific tools. We've got our own software that develops these tools to help you do this. And what we do is we put all your information into our Property Eagle software, put all your current information in there. So all your loans, all your assets, everything in there. And then based upon your goals, we start adding in different scenarios. So adding in property information, what loans you might need for that property, the property price. We add all those in. And what the Property Eagle does is it searches to see when you have the borrowing power and the equity to purchase that property. And it will keep searching and searching until we hit a milestone where those intersect. And then we keep putting in properties. And then by the end of it, in the 10 years, we've got a full plan of what you can achieve based upon your borrowing capacity. So not just pie in the sky numbers, but your numbers, what you can afford over the next 10 years. And we give you this overall graph, which shows by the next 12 years, your portfolio can be about 5 mil. This is a real customer, and passive income, 169,000. And it shows the growth of the properties, and also the growth of the passive income as well. So that's something that I do with my clients because I want to help them build a property portfolio. We also put it in Word format so they can easily follow it as well. So we find that to be really beneficial. They follow it along with it. But what I want to enter into now is what to consider when applying for commercial loans. It's important to have an understanding of the different banks. So there's major lenders. So we know the major lenders are Commonwealth Bank, ANZ, NAB, Westpac, Bendigo Bank, like to be the fifth alternative, Bendigo and Adelaide Bank. But they're the major lenders. And often when you're applying for a commercial loan, sometimes it can be difficult going through the major lenders. The reason is that they want all different documentation. So if you're a business, they want full financials. If you're a trust, they want trust financials and trust tax returns. They want the whole thing. So it can be a bit difficult for them. And some of their policy is quite rigid and structured. But the good thing about the majors is they do have good interest rates. The second tier lenders are lenders like ING, Macquarie, and Suncorp's now ANZ. So they're the second tier lenders. They're starting to do a bit more commercial loans, but they're quite niche banks and generally not the go-to banks for commercial loans. The other one is non-conforming. Now, the non-conforming space is really a space where I'm seeing a lot of loans and I'm seeing a lot of commercial loans. Non-conforming lenders, we're looking at a Liberty, Pepper, Bluestone. So as a broker, I'm accredited with all these lenders. So when I look at your situation, I look at which lender is best for you. Good thing about non-conforming is there's different levels of documentation that's going to be needed. If you want to give all your documents, then you can. But if you're limited with your documentation, then that's okay as well. And then there's also private lending, which is say a Capital, Finance, a La Trobe, a Paramount. They're private lending banks as well. But the three things to consider when you're applying for a loan is one of the main things is your credit score. So with the major lenders, they will require a credit score for at least 600 points or above. So if your score is less than that, then we need to look at other avenues. We need to look at sort of the second tier or the non-conforming, like I spoke about, in order to get that loan over the line. The non-conforming go with a risk grade profile. So the non-conforming don't actually credit score you as such, but they work out your grading score, and that can be consistent of, if you've got a default, then you might be an A. If you've got a couple of defaults, you might be a B or a C, or if you miss payments, you might be a D. It just depends on your situation, and it also depends on what documentation that you want to provide at the time. But if you can see in the graphic here, all of those factors constitute to your interest rate. So what the type of deposit that you're putting towards it, that will make a difference in your interest rate. So if you're borrowing 80%, then the interest rate is much higher than if you're borrowing for 50%. So all those things you got to consider when you're going into the commercial landscape. Often residential, you can borrow up to 90-95%, but with the commercial, it can be a little bit more restrictive, and you need a bigger deposit. So it's something really, really to consider them. So now I want to zero in to self-managed super fund loans. I'm actually doing quite a few of these in the past 6 months. It's the flavour of the 6 months. I think with borrowing capacities at its lowest at the moment, I think people are getting other alternatives to purchase property and to purchase commercial property. And purchasing a property through your self-managed super fund could be a good opportunity, especially if you've been building up your funds over the years. You've got regular contributions over the last 2 years, then it could be a really good option. So my first thing to consider is make sure you obtain the right advice. And I say trusted, certified financial advisor. Sometimes advisors like to peddle their own sort of agenda because they might get a personal benefit out of it. But just get a trusted person. Not all accountants can give you this type of advice. I know Carmel in this webinar can give you self-managed super fund advice, but it's important to get the right advice with the right people, and ask your accountant, are you a certified self-managed super fund financial advisor? A lot of them, from my understanding, aren't. So make sure you get the right advice there. Second thing is to look at your super balance. Is it really enough to purchase an investment property? So if you have to take out 20% or 30% of your super fund, is it enough for a deposit? Other thing is, how much do I need to borrow, which we'll look at, and what is my borrowing capacity, and then what are my repayments or interest rate. All of these are combined together, and considerations that you need to look at. Okay, so let me give you an example. Say you're there and you're wanting to purchase a property in your super fund, and you want to purchase it for $500,000. What's the first thing you need to do? First thing you need to do is gain advice. Don't rush ahead. Don't even talk directly to your mortgage broker. Talk to a person who can give you that right advice. And if they're giving you the tick, then I would then talk to a mortgage broker to work out the other details. So say we're going to be lending 80%. So if it's a $500,000 purchase, then to cover stamp duty, we're going to need at least $125,000 or $125,000 of your super to be a deposit for this commercial property. Now, different lenders treat super differently. So some lenders require you to have a certain amount of super left in your super balance. So some require at least 10% left over. So in this particular case, if we needed 10% left over, it'd be about $140,000. $140,000 in total that you would need to have. This is just my opinion, and I'll make disclaimer that it's just my opinion. I think it's important to have a lot more than that left in your super. You've got to realise that your super is there to also pay for any repairs or upgrades to the property. It's sort of also there if something goes wrong. You've got some super there to cover the costs. So you need to make sure that you've got enough there to cover the costs. So I think in this case, and this is just my opinion, is I'd be looking at something like this. If you've got, say, 200,000 in your super, that would be ideal. The other part of it is your borrowing capacity, and working out whether you can borrow the leftover funds to be able to do it. And not to be too sort of technical with it, but simply what it is how to measure your borrowing capacity is your super contributions, right? So we take your yearly super contributions, and we take plus the rental income that you're going to receive from that property. And that's what's called inflows. So what's coming in to the property. So that needs to cover your repayments. So that needs to recover your repayments, plus there's extra buffers on top of that. So that's why you need to know what's your loan to value ratio, because that will determine your interest rate. So you can see on here, this particular lender will actually go up to 90% LVR, which is quite high. But say for this one, at 80% it's 7.49, and then there's a commercial loading at 0.5 on top of that. So you need your super contributions need to be able to cover the repayments of that, and also the rental income need to cover all that in order for you to have the right amount of borrowing power to be able to take on that purchase. But as you can see, it can be a really good opportunity to buy something in your super fund. Good to do it early on so they allow the maturity over the next 10, 15 years to really take its shape. The other example I want to give is what's called a lease stock loan. So a lease stock loan, often you need a bigger deposit again. So up to 75% deposit, which brings the interest rate to 8.59. There is further fees and charges. So there is an application fee, a loan service fee, and 1.2, which I'll explain what is 1.2 ICR on actuals. I'll explain what that is, and minimum 12 months remaining on the lease to be able to have the requirements for a lease stock loan, and they consider 30 years based upon your profile. So let me just explain that a little bit further. So say if you were purchasing a property for 500,000, we need to borrow about 375 if it's 75%. So the deposit required is about 155,000, including the application fee. So if we have an interest rate of 8.59, the repayments are about 2,900. Now you need to be able to cover the rental incomes need to be able to cover the minimum repayments, times it by 1.2. So in this case, it needs to be able to cover about $3,500 a month. So the lease needs to be about 42,000 a year in order to cover the loan repayments. So hopefully that makes sense. But when you're looking at and you're searching property and you've got a buyer's advocate and you want to do this type of loan, you can borrow, say, 375. It just means that the lease on that property, in this particular case, needs to be about $42,000 per year. And I think that's workable and that's doable. So hopefully I have quickly helped you answer some questions. We got questions at the end of the webinar, but the first thing I mentioned is what you do before you go to the next loan. Don't just go out and apply for all these loans, and don't just get the biggest loan just because that's what you can borrow. sit down, have a property Eagle session, work out your borrowings for the next 10 years so that you're not all tied up. I hope they had a better understanding of different banks, different lenders, what they can do, and also self-managed super fund loans and lease stock loans. So we'll be open for questions at the end of this webinar. Thanks very much. And I think Carmel is up. Thank you, Carmel. Take it away.
Thanks, Nathan. Good evening, everyone, and thank you for taking time out of your busy schedules. My name's Carmel. I am an accountant. I operate M&C Accountants, and believe it or not, I have been working in accounting for over 25 years now, and I still absolutely love what I do. So in relation to tonight's session, we're talking about commercial property. And if I can get that to work, why invest in commercial? Now, Ashish covered this really well. The key points are, number one, commercial property does increase in value, but not as much as residential, but the cash flow is brilliant, which also makes it brilliant for self-managed super fund. The reason it's so good for self-managed super fund is number one, the cash flow, and number two, with the new rule that a lot of you would have heard about, the $3 million cap that's coming in 1 July next year, it means that you're less likely to hit that cap if you've got a commercial property in your super fund as opposed to a residential. The third reason is, as one of the participants' questions asked, if you are currently working in a business and paying for rent, it's almost a no-brainer. You work out your figures and buy a property and rent it from your other structure. Buying a property to rent out of is always better. To just examine the cash flow part, if you were to spend, let's say, $500,000 on residential or $5,000 on commercial, you're spending the same amount, but the amount you have to dip into your pocket to get additional cash flow changes. The rent is significantly higher with commercial, sometimes even double. The interest is also a little bit higher, but not to the same extent, but it's also your other expenses. If you're a residential landlord, you have to pay the council rates, you have to pay the water rates, you have to pay the land tax, which if you're in Victoria, this year was a killer. But when you're a commercial owner, you pass the water rates onto the tenant, you pass the commercial rates onto the tenant. And depending on your agreement, you may even be able to pass on the land tax. So then what I call the fun part is the structuring. So once you've done your plan, you've worked out what you can afford, it's time to work out whose name or what structure to put that property in. So if you are planning to retire soon, you may think, okay, I'll put it in mum and dad's name or yours and your partner's name. That way, when you retire, if this property is earning $40,000, because you've got no other income, half of it goes into your name, half of it goes into your spouse's name, and $20,000 that everyone earns is tax-free. So you've now got tax-free income. Another option is if you're like me and you've still got a lot of time to work and you run your own business, you can buy the property in a self-managed super fund whereby your business pays the rent, the cash does go across and it is at market rates, so you can't inflate it. But your business gets a tax deduction of the rent, which means you're saving money at your marginal tax rate. The super fund gets the cash, it can invest it or pay off the loan or buy a new property or do anything with it, and it only pays 15 cents in the dollar in tax. And as we mentioned before, you've got the $3 million cap, which, because it doesn't increase as much as a residential property, you're less likely or it will take longer to reach that $3 million cap. Another option, which I've seen people do, is that you buy it with your family members. And say it's a group of 4 of you. This year, one of you was lucky enough to go overseas for 10 months, so they don't have much income. Well, then you give them the profit, the bulk of the profit share this year. The next year, they worked all the time, so you can't give them much. but you've got another family member that went on maternity leave. So for that year, you pass the profit to the family member that's on maternity leave. So you can choose year on year who gets the profit. You can also structure it so if you want, no matter what the profit is, if we ever sell, we get 25% each. That can be done as well. There's also so many other options. Time doesn't allow it, but you've got to go with what works for you. That's the overriding principle. And on that note, thank you for your time. If there's any questions, please put them up on the chat and I will pass it on to Matt to talk about some legal aspects of commercial property. Thanks, Matt.
Are you speaking on mute? Yep, we can hear you now.
Sorry, can you hear me?
Yes, we can hear you.
Wait. And can everyone see my screen?
Yes, we can.
So good evening. My name is Matt Yakovlevich. I'm a senior associate at Nicholas James Lawyers in the property and commercial law department. Today, we'll start by discussing the contract of sale for a commercial property purchase. The contract is a crucial document that basically details the agreed upon terms between a buyer and a seller. And the key elements of a contract include the purchase price, the property description, the deposit amount, settlement date, and any special conditions. So it is essential to fully understand and effectively negotiate the contract of sale, basically to protect everyone's interest and minimize any disputes and ensure a smoother settlement process. So engaging a lawyer to help you understand the terms of the contract and ensure that they align with your understanding and ensure that due diligence is basically completed and the contract term negotiated is obviously critical before the contract is signed. You will need to basically consider the ultimate purchasing entity. So you may purchase your property in your individual capacity as part of a partnership company or trust. It is quite common for the purchasing entity not to be set up at the time of the contract being signed. So in this instance, what we can do is basically sign the contract in your own individual name, and then you can do a nomination nominating the contract into the ultimate purchasing entity before settlement. Finally, we need to also consider the actual goods, fittings and fixtures which are included in the contract price. This is particularly important if you are buying a property which is subject to a lease, because sometimes the goods, fittings and fixtures that you think are part of the contract actually belong to the tenant, and we need to make sure that we clearly specify which goods, fittings and fixtures are actually included in the price. Otherwise, there's going to be ambiguity and disputes. Now, moving on to financial considerations and the issue of finance. So to reduce potential risks, a purchaser should insert into the contract terms which states that the contract is subject to and conditional upon a valuation, or subject to and conditional upon finance approval by a certain date. This basically ensures that if the valuation is at a lower price than what you've agreed to pay, or if you have issues basically obtaining finance by the due date, it will basically allow you to cancel the contract and be entitled to a full refund of the deposit monies paid. If your contract doesn't contain a subject to finance clause, you may be obligated, obviously, to complete settlement and risk losing your full deposit, as well as be up for claims brought against you by the seller for a breach of contract. So it is essential to have, where possible, a subject to finance clause in the contract. Next, we will discuss the GST component on commercial property purchases. So generally, 10% of GST applies to these transactions if the seller is registered for GST or required to be registered for GST. You can, as a purchaser, you can obviously claim back the GST in your next business activity statement lodgement. However, it's important to know that you obviously must have sufficient funds to cover the GST, unless, of course, you are buying a property which is subject to going concern or subject to a lease. So what we need to ensure is that any contract that is subject to a lease, we need to ensure that the lease does not end prior to the settlement date, because if that happens and a lease is terminated right before settlement, you will most likely be liable to pay the price plus GST, which will obviously cause a bit of unexpected financial stress right before settlement. Now, moving on, another cost to consider is the transfer duty, which is basically calculated on the purchase price plus GST. So obviously, if a property is sold as a going concern, you'll only pay transfer duty on the purchase price. And that obviously in Victoria, that's at 6.5%. Similar states have, different states have similar legislation in relation to that. Now, going back to if you are buying property subject to an existing lease, it is very important to basically review the lease, as a buyer is bound by any lease that's currently disclosed in the contract. So some of the items that you should consider is the length of the current lease and any remaining options to extend the lease. Ascertain whether the tenant is in default of the lease and any arrears of rent and outgoings, and see if there is a tenant that's currently a company. Ascertain whether there are any personal guarantees that the director of those companies has basically put in place, and if there's basically adequate security in relation to that. A lot of the times we see special conditions whereby a purchaser is liable to adjust their rent as being paid in full, even though the tenant may be in arrears by, let's say, a few months. So obviously, if we see those special conditions, we do try to negotiate with the vendor and say that it is unreasonable for a purchaser to be expected to pay and cover the rent and then try to chase a tenant after settlement. And finally, moving on to other disclosures, which has already been briefly discussed, but we do also need to verify the property's title and plan. So we do usually recommend that you engage a building surveyor to ensure that the actual physical dimensions of the property match with what's on the title and the plan as contained in the contract. And in addition, the title will also have information about any registered mortgages, caveats, and any planning agreements, as well as any restrictive covenants which affect the property and which would basically restrict what the potential use of the property is. And what we also need to consider is any property improvements. So that includes any structures that are built without a permit or without a final inspection by the seller. So if the council inspects the property and discovers an illegal structure, it will be your responsibility to rectify the problem at your expense after settlement. So obviously it's best to uncover any unauthorized works before and illegal structures before the property, before the contract is signed, so that we can basically have clauses in the contract to hand over the responsibility and to make sure that the issues are rectified at the seller's expense. Now, lastly, if you're considering buying industrial commercial property, we do suggest to engage in an environmental consultant to assess potential risks such as asbestos and toxic material in the soil, and also the costs associated with any remediation works. Given it's likely that any contamination will become your responsibility once the sale is finalised. If contamination is found, negotiating what's called an indemnity clause to have the seller cover the cleanup costs will be essential here. So clearly, negotiating the contract, having clearly written terms within the contract is obviously imperative, because the cost after settlement can obviously be quite significant. And finally, just to recap, due diligence in general and due diligence clauses are critical when buying commercial properties. So please ensure that obviously a due diligence clause is inserted in the contract, and make sure you take your time to obviously just do the due diligence carefully and make informed decisions to basically avoid potential issues and disputes at settlement. And basically, we'll now revert back to Ashish for any questions.
Yeah. Thank you, Matt. Thank you to our four speakers for all the fantastic information you have shared this evening. There has been a bit of activity for Q&A, so let's review some of the questions we have received. I guess some of the questions have been answered already, and there is a first question over to you, Ashish.
Yeah, so Richard asks, is it a good time to buy an office space in Melbourne or Victoria in general? Look, unlike residential, there are certain cycles and patterns that commercial property follows, but I believe it is always a good time if you've got the right type of property. So office spaces, I would not be looking at high rise within CBD. Again, just obvious answer, because there's a lot of similar properties available and not everyone is going into CBDs. So I myself, as a full disclosure, have bought an office space in last 3 months, and that's in one of the suburbs around 40-45 Ks from the CBD. Bought for 690, returns about 7% net, or around 47,500 a year, with a 3+3+3 lease in place. So it's on the first floor in a 2-floor precinct, and a very small precinct. Ground floor is retail and way more costlier than the office spaces. So yeah, I definitely think there's potential. If you can buy, you should buy. The second question is buying an office space a bad idea? It's like a high rise. I've explained you what and where. High rise I might just avoid. I've also bought a personal office space at 4th floor in a 6th floor precinct, but that's northwest area of Sydney. I don't know if you're aware or not, but there's all high rise office spaces there. So I still, what's important is the access. If it's a single entry or dual entry and exit, the access to major roads, precinct, a retail precinct at the ground floor. There's a fine dining at the top floor, which is floor number 7. So there's few aspects that you can look at which should define, and there's also a 24-story residential tower right next to it being built, which could give a decent amount of traction. And at 4th floor, again, you go a bit high and the value goes up because it's got views as well, because it's corner, right? So you can figure out based on that what exactly you're buying and what not. So given the third question is, given the same budget, say 2 to 2.5 million, is it better to buy in major regional area with a freehold land rather than strata in CBD and metro? I definitely would say so. If you can go into a major regional area and get better yields and better land, because the value add in commercial is huge at times because you're buying mostly on the basis of the lease or the cap rate. But then if there's empty land that you can use to build an extension, your rentals would go up. So it's subjective, but I just in a nutshell, I'd definitely look at buying in a major regional area if you get an option. My personal investment style is mostly sticking to uh, major commercial precincts within the suburbs because that's where a lot of demand is moving towards. Like say the office that I bought is occupied by a real estate agency that's been in business for last 5 years, and they do commercial purchases themselves. So what's important is just making sure the lease terms are right. Yeah, that's what my answer to your question would be. I hope I'm able to answer. If not, just we can touch base later, and I'm happy to just extend the conversation.
Thanks, Ashish. I believe the next question is directed to Matt. Can the tenant cancel the lease before finishing the lease term? How the rent would be covered for the remaining term?
Let me just. I've got the camera working now. So basically, if a tenant were to cancel the lease, I mean, they'll have to have grounds to cancel the lease. If basically they just said, one day turn around and say, well, we no longer want this lease, we're cancelling, who will cover your rent? That would be considered basically a breach of lease. And in Victoria, the matter would be referred to VCAT after obviously you first issuing a default notice on the tenant or notice of default. You would probably at VCAT will issue a possession order, basically advising that the tenant has breached. So, and it depends what type of, obviously, what the lease agreement says. That's basically the general procedure, but it is on an individual basis. So we do need to obviously review the lease carefully, the terms, and see why the tenant has cancelled or trying to cancel the lease in the first place before we can provide that advice. So it is on an individual sort of circumstance and basis as well.
And Matt, correct me if I'm wrong. I think there's the usual bonds are for 3 months, and there's personal guarantees in place. So how do we use those when it comes to someone breaking the lease?
So those will definitely be used and can be enforced. So especially if, for example, as I discussed, the tenant is a company, if there is a breach, the person or director usually who has provided those personal guarantees, they will be personally liable to obviously personally liable for that breach. So if, for example, a tenant company or the company decides, or the director of that company decides to deregister the company to avoid that liability, it will obviously divert back, and the ultimate liability will fall on the person that has provided that guarantee.
As we see, usually there's issues with residential evictions because I think VCAT would give an extra time, or tribunals would give an extra time to the tenants, another 2 or 3 months to pay. I think it's pretty quick in commercial. Am I right in thinking that?
Look, it does depend as to the actual individual circumstance, and obviously, how far we want to take this in terms of obviously getting a resolution. So it is basically on an individual basis or case by case basis.
Got it. Understood. And again, just one more question. I'm not sure if you're the right person, and I think anyone who knows can pitch in. Um, The usual insurances in case of commercial is mostly a liability insurance, not unlike residential where we buy building insurance and landlord insurance. What sort of insurances would you usually recommend to get when it comes to commercial property?
In terms of, sorry, can you repeat that?
So,
I was just
like
thinking,
we had,
through.
no, all good. And again, that's why I said I'm not sure if you're the right person, but I've seen mostly on residential properties, we buy a building insurance and we buy a landlord insurance. which covers us for rent defaults and things like that. But in commercial, I haven't seen much of these insurances in place. But I was talking to an insurance provider, and they said you just need a liability insurance. So, especially if it's a strata property or a warehouse. So, are there any recommendations from your end with respect to insurances?
That is so what I think you're alluding to is the public liability insurance, as well as, so if there's an owner's corporation, there's shared, property, generally you would need a public liability insurance of at least 30 million at the moment, to cover any sort of injuries and accidents that happens in the shared sort of property or common property, should I say. I think that's what you're referring to here. So that's sort of different to landlord insurance, for example. But yeah, there are different types of insurances. So obviously, if there is property which is part of an owner's corporation, generally the owner's corporation will take out insurance and have the common liability insurance in place as well. So there's no need to have an additional building insurance, just obviously contents.
Right. And does the landlord insurance is also applicable for commercial purchases usually?
Yes, they can be.
Okay, got it. And in some cases, I think we can pass on the cost of insurance as well.
That's correct.
Awesome.
Yes.
Okay. Thank you. The next question looks like it is for Matt again. What options are there to get out of contract once the finance clause has expired and deposit has been paid? There is a room for negotiation with the owner.
Look, trying to get out of the contract in that instance where you have an unconditional contract is, if there's an unconditional contract, is difficult. Number one, because in that instance, a real estate agent would want their commission being paid because they did obviously find you a purchaser and the contract is unconditional. So they will be entitled to their commission. Now, number two, the best option if you do obviously have an instance where the finance clause has expired and you just cannot complete the settlement, what I suggest we do is try to find another person, using the real estate agent's help, and just nominate the contract to that purchaser, and hopefully, they will be able to complete the contract on your behalf. So those are the two sort of options. You can go back and say, please let me out. But in 99% of the time, if there's an unconditional contract, unless the vendor has someone else lined up, then in that instance, your best case scenario is to have the contract reviewed, have the vendors or sellers disclosure statement reviewed, and see whether there's a defective, in Victoria, it's a defective Section 32 or vendor statement. So your best bet is to review the contract carefully, review the Section 32, and basically try to end the contract on a legality. So basically forcing the vendor to say, well, I'm allowed to end the contract. I'm entitled to my deposit because you've made an error in preparation of your legal documents.
And Matt, there's another question which has been answered a little bit, but someone asked that they purchased a property, it's under contract, but then they found out that they might have paid $70,000 to $100,000 extra as compared to the market value on the property. So the question is, can I get out of the deal as the agent falsified the claims about the property?
Again, that will largely depend on what type of misrepresentations were made by the agent, and it will also largely depend on what type of special conditions are in the contract. A lot of the time, there is a condition in the contract which basically states that the entire agreement between a seller and a buyer is contained within this written contract, and anything said outside of that contract, including by the vendor's agent, cannot be relied on. So we see that condition a lot. So it depends who made the representations, when it was made, whether obviously you were enticed to buy the property on that representation. And that's why I'm going to go back to that, to what I've discussed in terms of finance. those two conditions where it's either subject to finance approval or subject to satisfactory valuation. Those are two different things. I mean, if you get your finance approved, but the value comes, as you said, $200,000 lower than what we expected, you're still expected to come off the shortfall. So you're better off actually having a clause that says it's not subject to finance approval, it's actually subject to valuation if you're concerned, especially if the property is a bit unusual and you just, or first time on the market and you just don't know or don't have any comparable sort of sales and knowledge as to what that value will be. So I think in that instance, having both of those conditions is basically paramount.
And Matt, I've seen, and again, we do the same. So we put a blanket clause which says subject to a due diligence period of 3 or 4 weeks. Do you think that would cover everything that comes under due diligence from a finance, building, zoning, and all of those checks perspective?
Well, usually with our due diligence clause, we do have about 7 subsections within that one clause, which would cover all aspects. So, doing your reports, having a right of access to the actual property. So it's not just individually having, subject to finance, having subject to valuation. It is also due diligence, which includes all those aspects depending on the property. Especially if, for example, it's industrial, whereby you do need to make sure that the land is not contaminated, because if you don't have that clause in there, and you something and you sign the contract, and then the vendor gets a notice that there is contamination, and that's before something has taken place. Any notices issued on the property after you sign the contract will become your liability, even before settlement. So that's why it's important to have these clauses in place, and obviously take your time. They're not always possible. So the subject to finance clause is not always possible, especially if it's an auction contract, because you have to sign an unconditional contract. So we have to obviously be careful here. But usually, once the property is advertised, this is when you should probably start negotiations. Even though you're not a successful buyer yet, you could approach a real estate agent and say, I'm really interested in this property. In the background, can I actually start my due diligence but not have a clause? So it's obviously not going to be a part of your, terms of contract, but at least before the auction, which could be 4 weeks away, in the background, you can actually start doing your informal due diligence. Does that answer the question?
Yep.
Yes.
Thanks, Matt. Yeah. So the next question is from Karthik. Can a commercial property have a limitation on a type of business that can run, and also cap on number of visitors, parking on any precinct? Is this info looked up on zoning? Probably Ashish can answer this.
Yes, so we've had a recent experience where we bought for a client, and the client wants to run a cafe, catering business, and there were a lot of checks and this referral, and the client's been in the market for like 6 months now. Yes, you're right. There's definitely limitations because per square meter, or let's say per 100 square meter, they need about 2 parking spaces, and that shop was 125 square meters. So they needed 3 parking spaces. Now, we engaged a town planner, and I think they'd be the ideal people to get in touch. And we did a pre-council, like a pre-meeting as well with the council, which would come at a small cost, but I think it's well worth to pay that cost instead of taking a hit, because we bought that property for $515,000 on a liquidator auction. So now the argument that we gave was there were ample visitor parkings, and every other shops which were really small, like 30 to 70 square meter shops, also had 2 parking spaces. And if we needed, we could have leased a parking space on a longer term basis, so we could have run a cafe from there. So yes, zoning is really important to see whether a cafe would be allowed or not. Comes under retail, while a catering business can, with no shop front, can not necessarily has to be considered retail. So there's no customers coming, and there's no issues of parking. So there were 2 things: one, running a catering business, and second, converting it to a cafe and seating space as well, which needs more parking spaces. All of this information comes through the council, not necessarily through zoning. Zoning only makes sure that you're allowed that type of business.
Yeah. Thanks, Ashish, for that. So next question is to Kamel. Is family trust better or using SMSF a better option? Would you go with trust only when there is a positive cash flow? If there is a negative cash flow, I heard trust does not allow to claim your liabilities.
Thanks, Jordan. And that is a great question. And the simple answer is there is no answer. It all depends on your situation. So whether it's a trust definitely can't distribute out the losses, but the losses aren't lost. So they do sit there for in future years where you have profits. So say, for example, your aim is to buy a property and flip it in 3 years. Because you're going to make a capital gain, you can offset the losses at that point in time. And by having the property in a trust, you can split the capital gain minus the losses to the people you choose, the beneficiaries. And you can choose who those beneficiaries will be based on their other tax situation for that tax year. So a trust is never a yes, never a no. It depends on your situation. In relation to super, you've got to look at, do you need the cash now? Because if it's in super, it's locked away. So it's a retirement vehicle. Also, do you have the funds to start it up? Because to set up a super fund is not cheap. You're looking at a significant amount to start it up, and it's also a considerable amount each year to maintain it. The current financial planning rules are looking towards the $300,000 mark in super before it becomes viable to actually open one up. So that's just a couple of things. Again, depends on your situation and what your goals are. So there's never one answer for everybody.
Yeah. Thanks for that, Kamel. That answers it, I guess. The next one is, what are the main risks in buying commercial property and how do we mitigate it? Good question. I believe from our perspective and the finance perspective, I believe Ashish and Nathan can answer this one.
I think it will be from all perspectives, from legal, from finance, from accounting as well. Yes, but major risks, I think some of them that I can easily recall and just add are issues with zoning, issues with buying a wrong property, wrong location. There could be longer vacancies, like some of the warehouses we bought in Queensland and even Melbourne for that matter. They don't stay vacant for more than 3 to 8 weeks. And that's the beauty of buying in a location where there's a lot of footfall or demand. But the risks can be vacancies, risks can be buying the wrong property or the wrong type of zoning. Risks can be, we need a higher deposit and we've not factored in a deposit. The bank can come back and reduce the LVR straight away because of risks in the property. So you need to be prepared. You need to put the right conditions in. I think I'll go if anyone else from Kamal, Matt, or Nathan wants to add anything else.
Yeah. Nathan, anything from finance perspective?
Yeah, so I suppose there's a few risks involved in it. One of the major risks, obviously, is the interest rate increases. I know, especially the past 18 months, it's been an interesting time for interest rates and the increase, which has made some investments not viable. And especially if you buy in your super fund, you've got to be very, very careful. Very, very careful. Because you've got to be able to cover those repayments. And that could get you in big strife. You can make extra contributions to your super, but you are capped to how much you can make with that. So interest rates, especially the past 18 months, have had a huge effect of it. Obviously, with tenants, just walking off the job, so to speak, and not paying their rent, that's something that is a big risk as well. So if you combine it with interest rate increases and tenants not paying, because tenants for commercial need to pay all the outgoings. So they're paying electricity, they're paying body corp, they're paying all the outgoings. So if they stop paying the body corp can be thousands of dollars a year. That can be thousands of dollars out of pocket. So while it's good that the landlord is not paying the outgoings, you can come into strife if the tenant stop paying the outgoings. So there's options to refinance. There's options to get money through private equity lenders. So there is options there. So don't drown. Talk to someone straight away about it if you're in financial difficulty. Hopefully that helps.
Yeah. Thanks, Nathan. That's a good answer. The next one from Roshan, more of a comment than a question. This has been the most well-run webinar I have attended in a long time, and I have attended a few. A diverse range of experts who have explained what is usually a complex subject in such a simple way. Thank you, everyone. Thank you, Roshan. Appreciate that. Any more questions? We still have another 6 minutes. If anyone has any question, you can type in here. Okay, in the meantime, I'll ask a question okay, there's one more question. Would you be able to send the recordings to everyone? Yeah, I believe it's been answered, yes. Yeah, okay. Okay, there is one more. Can we add a finance clause in the contract in all the states? I believe yes, but I'll just let Matt answer this.
Yes, hello. Sorry, I just responded to that question. So in some states, you are not allowed to sort of have a subject to finance clause. So what we try to do in that instance is basically extend the cooling off period to make sure that you can, in the meantime, then get obviously finance approved. So that's a way around it. And I've actually just answered that in writing just moments ago.
Thanks a lot, Matt.
No
So
worries.
still 5 minutes, and I'll just ask commonly asked questions so that it could help others as well. So what is the minimum purchase price for a good commercial property, Ashish?
I'll keep an ideal price point of anywhere between 600 to 800. There's no reason why we can't buy cheaper properties as well. In the recent example, Chetan, when you represented a client in auction, there were some 280 to 350,000 shops as well, but they were empty, which means you would be liable to pay a GST on top because it's not a going concern, which Matt explained. But then, yeah, there are cheaper properties available. It's just hard to find. Ideally, 600 to 800 is a very nominal budget to consider.
Okay, thanks, Ashish. And what happens when a tenant defaults? This was asked before, so I just thought of asking it again. Before, as in not today, but one of the clients asked the question, so it could help others as well.
I think it was covered on one of the questions. I believe Matt did cover that. That there was some like if the defaults, because we were talking about the 3 months bonds and the guarantees when personal guarantees involved. Matt, correct me if I'm wrong.
Yeah, we have discussed it, and I just mentioned as well in Victoria, you generally refer the matter to VCAT. So you should have default and then refer the matter to VCAT and try to resolve it that way.
Yeah. Cool. So there will be a bond held as well, right? So that can be used in the meantime.
That's correct.
Okay, awesome. And there is one more question to Nathan. If you are purchasing the commercial property using the cash, would you still need to pay the GST?
Is that for me?
Yeah, it's mentioned as to Nathan.
Oh, okay.
I think it goes to Kamal, if I'm not wrong.
If they're registered for GST, then they need to pay the GST. But Carmel can answer that.
It also depends on the contract. So if it is a going concern, there won't be any GST payable. If it's not a going concern, like Ashish just said, and it's an empty property, well then if the vendor is registered for GST, there will be GST in that contract. But the contract is key to answering that question.
Okay,
And
awesome.
I think it's same as residential, where it actually marks whether whether the sale includes the GST or not, and we have to be careful because otherwise the buyer would be liable to pay that GST.
That's exactly right.
Yeah. Thanks for that. We just have 2 more minutes. I just have one common question. What is the average interest rate as opposed to the residential, Nathan, for commercial property?
Yeah, so it depends on whether it's a major, minor, or non-conforming lender. Usually, as a general rule, it's often say 1% higher than say a residential rate as a general rule. But as you saw from my other charts, it just depends on so many factors. It depends on LVR. It depends on the risk profile of the client. What the interest rate will be. But yeah, generally it's 1%,
Yeah.
1% higher, 1 to 2% higher.
Okay, thank you.
Chetan, there's a hand raised. I think you can just allow to talk. Sagar has raised his hand.
Just a second.
It's gone. Could be a
Okay.
mistake.
Yeah, but
That's okay.
one more question. I believe we just have 1 minute. I hope it won't disappear. In Victoria, what is your opinion on stamp duty waiver? Who can answer this question?
Yeah, so sorry, in terms of opinion on the stamp duty waiver?
Yeah.
Is this my opinion? I mean, it's going to take some time to get used to. So basically what the Victorian government has introduced is called the CIPT, and it will over time basically remove over time, so in about 10 years' time, it will remove stamp duty being paid upfront. So right now you have an option either paid upfront or over 10 years, and there's also basically an option to get a loan from the Treasury, which will help you pay down the obviously otherwise stamp duty or transfer duty over time. It is basically a new legislation which we're still sort of trying to see how it will work in practice. Obviously, it is. So we've had a few already clients where that was applicable, but again, we'll see how it's going to operate. So I don't have an opinion as yet, but obviously, as things progress, we'll see how that's going to operate in practice.
Yeah. Thanks, Matt, for answering that questions. I believe that's it. And thanks everyone for joining us today. I hope this webinar helped everyone.